Hey, it's Vittoria Logli with At Properties, and this evening we're going to be discussing opportunity zones. So I'm here with John Nicholas from Chicago Partners Wealth Advisors, and he just recently brought to my attention a really cool investment opportunity that I had never heard about, and it's called opportunity zones. So thanks so much, John, and you want to just kind of dive in and let us know what they are?
Sure. So the 2017 uh, Tax Cuts and Jobs Act had a provision in it that related to investing in distressed and really sort of downtrodden areas of the country that could use investment to help boost their jobs and their the renovation of their communities.
Okay.
So it was sort of under the radar screen, but has become more prominent now in the
It's kind of
last
like a
year.
hot topic lately, right?
Yeah, yeah, become a hot topic, and it's because it's according to analysts, it's one of the most attractive tax deferred, and tax
Mm-hmm.
exempt opportunities in the last 25 years. So it was a bipartisan bill
Okay.
designed again to help these communities in need. So you can think of it in some way as being sort of a social impact type
Yeah,
investing
social
because
impact investing.
right.
That's really nice.
So they want to give investors an incentive to invest in these communities.
Okay, so how is an individual, say like myself or my husband and I, how are we able to take advantage of this um, opportunity?
Yeah, probably the best way if you're not a professional real estate investor, and there are 8,700 of these census tracts around the country that have
Okay,
been identified as opportunity
and there's
zones.
plenty in our areas, right?
There,
Chicagoland.
yeah, there are quite a few, and you
Okay,
can find them online. There's actually a database of all of the available census tracts around the
okay,
country, and those are just geographic areas that have been designated by really governors and state and local officials as to the areas that they would designate as being open to this kind of investment.
got it. Okay,
So the best way, if you're not a professional real estate investor, would be to go through a fund. And there's many funds that are being set up
okay,
that are really run by professional real estate investors
okay.
who will be sifting through the various opportunities and then putting together, hopefully, a diversified portfolio of these. So you're not just investing in one building, but you're
Okay.
investing in a number of different opportunities around the country.
So this is, as you were saying earlier to me when he was sort of explaining to me earlier, it's a way to defer taxation on any gains that you've made on an investment.
Yeah, there's two
Right?
things. And then, Victoria, you're familiar with 1031
Yes,
exchanges, where
absolutely.
you sell a piece of property that you
Right.
have a big gain in. If you roll it into a like kind or similar property,
Right.
you can defer the taxation on that.
Okay.
And the good thing
Right.
about that is the money keeps working for you over time rather than taking a chunk of it and paying that away to taxes.
Right.
This is a little different,
Okay.
similar, but has a few twists. The difference mainly is that you can use not only gains from real estate, so a commercial property, even your home, but you can use really any gain on any asset. So it
So
could
even
be,
a stock, like if we have Google stock and we bought it, 20 years ago or however many years, not even 20 years ago,
right.
and we have all this money, we can invest it in these opportunity zones.
Yes, if you invested in the FANG stocks, Facebook, Apple,
Right.
Netflix, Google 10 years ago or 5 years ago,
Right.
you're sitting on a big gain. You could use that. If you're selling it, so you sold your business or selling your business, you could do that.
So show us how that works. Say I have $100,000 profit that I've made from selling off, one of these stocks. How would that work?
So you have a $100,000 gain, and
Mhm.
normally you'd be paying tax on that gain if you recognize the gain.
Right.
It could be short term, but typically would be a long term gain. So
Okay.
it's really 20% plus
Ouch.
3.8%, which is a net investment income tax for people that are in a higher tax bracket, and then
Right.
you have state tax. So you're really looking at
Lobbing
ballpark
off.
around 28.75% tax. That's
Ballpark.
long term. Now that could vary depending on your situation,
Right.
but just use it as a
Okay.
benchmark. So rather than paying tax on that,
Okay.
you could roll that into one of these opportunity zone investments. Now, what happens when it goes into one of these investments?
Right.
The goal of the government really is to create long-term significant investment in these communities. So what they do is if you keep the money there, and this is through 2026, the
Okay.
reference point, if you, say, invested this year and had a 7-year investment period,
Okay.
you would get a 15% discount on your tax. So basically, your 100,000 in gain In fact, the basis moves up, so you'd have in effect 85,000.
And they tax you on the 85,000 versus the 100. Is
Correct.
that okay?
If
Okay.
you do it in 5 years, which would be if you started in say 2021,
Okay.
at 5 years through 2026, it would be a 10% discount.
Oh, okay.
Now, what does happen in basically year 8, which would be 2027,
Okay.
you would pay tax on your 100,000 in gain, but it would be at the discounted rate. So it would be at say the 85% rate or the 90% rate. So that's a nice benefit. But the real benefit is if you keep the investment,
Right.
your 100,000 investment through year 10.
So 10 years is the magic number.
Yep.
Okay.
Year 10, that's the threshold. If you keep it through year 10, and say it appreciates by 100,000. So
Okay.
say your investment, you're putting 100,000, it's now worth 200,000.
Right.
The gain of 100,000, if it comes out of the fund, when it comes out,
Okay.
there's no tax on that. So it's tax
Zero.
free, zero. And that's
the gain on the investment made in the opportunity zones, not your initial.
correct.
What rate are you taxed at on? So you have $100,000 gain, that's tax free. But then what about your first 100,000? How does that?
Yeah, so you get the discounted tax on that, say either 85%
Okay.
or the 90%.
Okay.
You'd be paying long-term gain on that.
Got it. Okay.
So what's the benefit of that? You're deferring that tax for basically 8 years.
Right. 8 to 10 years ish. Yeah.
So that's a benefit because it's allowing that money to be invested in the opportunity zone for 8 years.
Right. In order to really be able to help these communities and not just pull the money out, but just have it work too.
And you do pay tax on that.
Right.
But the particularly strong benefit from a tax perspective is that any gain on that investment, as I mentioned, comes out at no tax.
Wow.
So that's a real incentive. Now, I should say, too, is that some of these funds, and it is a new concept, if you're investing in, say, commercial real estate, a building or other property, they'll probably will be generating income at some point before the 10-year period. So there should be some income theoretically coming out of these investments.
So the type of investment, if it's something that generates income, large housing complexes, commercial real estate, as you had said.
Apartment complexes, parking garages, commercial storage facilities, that sort of thing. Should be income coming off that.
Oh, that's
and it
nice.
seems to be, although there's still a bit of a gray area, but it seems to be that income may in whole or in part be tax exempt. So that's a real attractive.
Wow, that is very attractive. What's the risk in something like this? I know it's a new program, but what is your sort of professional opinion of the type of risk I'm going to be taking?
Yeah, there are significant risks,
Okay.
right? The whole point of giving people an attractive tax incentive is that these are distressed communities in large part.
Yes.
And there's definitely risk, investing in properties there. The main risks are that the investment has to be done within 31 months of when it starts. So that's a fairly tight time frame for, say, these professional investors, if you go into a fund, to invest in these properties.
Okay.
When you invest in a property, and these would be sort of the professional investors,
sure.
say they buy a building for $1 million.
Okay.
They're required to do improvements of $1 million.
Oh.
So they're not just going to buy a building; they have to actually do something constructive
to make it, and improve the community, improve everything. Yeah. Okay.
So that's a significant commitment that they're required to basically put in improvements as much as they actually purchase the property for.
Okay.
So that's a potential risk. There is a risk that there may be a lot of people interested in these kind of funds and investments. The most attractive opportunities around the country, could get a lot of attention and therefore be bid up in price. And then in 10 years' time, when a number of these funds are looking to sell these properties, you may have a lot of people all selling at the same time. It's as if everyone was selling their house at the same time.
Yeah.
So those are a couple of the risks, and they are significant. So I would consider this to be a fairly high-risk investment.
Okay.
And that's, again, why the government is giving people incentives, because it's not for a real conservative investor, for sure.
Okay. And this is more so to diversify. And if you are a socially conscious investor and you want to do something to help your communities or communities around the country, it's a way for you to invest. But if you only have 100,000, then that's not such a good idea. Or we're just throwing out that number just because it's even number.
No, you would not put your retirement savings into a single a fund like this.
Right.
For sure.
Okay. So what kind of people have you seen? And it's been what, 2 years? Not quite 2 years. I mean, any?
Well, the program was just the properties and the census tracts were really identified by the state and local officials in the spring of last year.
Ah, okay.
So it's a fairly new program.
Okay.
And there's been a number of new funds started. And that too is a risk because you want to be investing with people who have some sort of real experience or track record.
Right.
Not someone who's just jumping on the bandwagon.
Yes. Yes.
So there's quite a bit of activity and interest. It's something new.
Okay.
For the right kind of investor.
Sure.
There are attractive characteristics, as we talked about.
And for those investors too that are out there, because I have, lots of clients and friends that do like to buy investment properties like buildings or gas stations or, whatever it might be. This is a nice avenue for you guys to explore in your next round of purchases because the tax opportunities are huge. So, yes, of course you have, your funds, which makes it easy for like the regular guy. But for those people that have a little bit more experience in purchasing larger buildings or, like I said, commercial properties or gas stations or whatnot, looking at in these specific opportunity zones really might be worth it for you, from a tax perspective.
And there certainly is the opportunity. Some of these census tracts, are adjacent to areas that are growing, developing, or attracting. Could be near airports, some are near universities or colleges. So student housing, apartment complexes, parking garages. There's, fuel depots was one for an airport. So there are all kinds of opportunities. If you're a sophisticated investor, obviously there's an opportunity there.
Right, and it's all over the country, right? It's like more urban, would you say, or did they identify?
It was interesting. The bill was sponsored by Cory Booker from New Jersey, and actually Senator Scott from South Carolina, who was representing rural districts that really needed investment.
Right,
so
this
it's
is
really
true.
All over the country, both urban, but also out in the country.
Right, that maybe have suffered from some downturn for various plants that have left or moved out, and maybe even.
Exactly, like a lot of these areas that haven't quite rebounded from the recession of 2007, 2008.
Gives them a little kickstart.
Exactly.
That's really nice. I think that's really phenomenal. So if someone wanted to find out about these opportunity zones besides going to the government, which we'll put a link at some point, we'll get the link for you guys so you can look at it. How would they would go to someone like you who's a wealth manager and explore you would be able to give them a couple different options in funds. Is that?
Yeah, you would talk to your investment advisor. You certainly want to talk to your accountant as well. This is really a tax angle, certainly related to this, and see if it makes sense for you. Given your entire financial situation.
Portfolio, right. So again, this isn't for someone that, only has a certain amount of money because it's risky. It is, high risk, high reward, right? That's just sort of the game of life, but it can't be your entire nest egg. Not a good idea. So, but yeah, talking to your advisors, your accountants and whatnot, but I think it's a really cool angle for someone that wants to do, or a family or whatnot that wants to do things that are more socially conscious and impactful.
Yeah, we say it's sort of doing well by doing good. This would be one of those types of investments.
Yeah, that's great. Am I missing anything else? Is there anything else we kind of need to?
Just sort of the high points. There's additional detail, but those are the high points of the opportunity.
Okay. Great, wonderful. So thank you so much, John.
Thank you.
So John, again, is with Chicago Partners Wealth Advisors. And thank you for joining us. And we'll include links to various topic discussions that we've outlined tonight. And so if you have any questions, feel free to reach out to John or I. And thanks again for joining us. Take care.